The U.S. housing market bubble is running out of control. A growing number of experts have been warning the Federal Reserve has been blowing the current price bubble by keeping mortgage rates at historically low levels, enabling prices to reach unprecedented highs. However, things are becoming increasingly unsustainable, and the threat of a housing market crash of epic proportions is looming on the horizon. One of the most evident fundamentals that indicate why something is wrong in the market is the fact that during the worst recession this country has ever seen, which led to millions of bankruptcies and job losses, the housing sector remained heated, despite being a cyclical sector that usually cools off in periods of recessions. Market swings are completely natural during economic downturns, but throughout the current crisis, the housing market has been artificially supported by low interest rates and rising household debt. The latest quarterly report on household debt and credit pointed out that total household debt went up by $206 billion to $14.56 trillion in 2020's fourth quarter, partly as a result of a sharp increase in new mortgages. They were $414 billion higher than at the end of 2019. Recently originated mortgages, including refinances, hit a record new high of $1.2 trillion, surpassing the figure seen even during the housing boom of 2003. On the other hand, the remarkable surge in home prices and household debt have deteriorated the Housing Affordability Index, which measures whether a typical family makes enough income to qualify for a mortgage loan on a typical home at the national and regional levels. According to data released by Atom Data Solutions, the median price for single-family homes and condos in 2020's fourth quarter was less affordable than historical averages in 55% of counties, an increase of 43% from a year ago and 33% from 3 years ago. The expanding gap between home prices and affordability is a clear sign that the housing market is in a dangerous bubble territory, just as seen during the previous housing boom. Housing data is reaching levels last seen in 2006, and industry experts are concerned about the impacts another housing bubble will have, particularly considering that 15 years ago, the 2008 real estate bubble burst threatened the stability of the entire global financial system. And today, we're experiencing the same levels of inflation, but a lot more money is flowing into the sector, which means the crash is bound to be much more extreme. Today's market is already creating major imbalances across several segments of the economy, and although this rally might look different from the last one, the market's principles remain the same. That's what billionaire real estate investor Jeff Green has recently argued in an interview with CNBC. Now, Green, who made a fortune shorting subprime mortgages more than a decade ago, said this is an omni-bubble. When asked for how long this euphoria would last before a crash occurred, the investor said, "It depends. How long do you keep the faucet open and this money running? There's just so much money in corporate balance sheets and people's balance sheets and their bank accounts that it's just driven prices of everything higher. But at some point, this has got to stop." Green believes the market is overheating right now, and his previous bet against the housing market in the mid-2000s makes his comments quite notable. When you see prices go up the way they've gone up, you have to ask yourself, why did this happen? He outlined, affirming that the extraordinary monetary and fiscal policy response to the health crisis played a key role in fueling the current bubble. Americans have also been posing the same question, and Google data show that in recent days, searches for "when is the housing market going to crash" have dramatically increased. In essence, consumers have been growing worried that the housing bubble may be ready to burst in face of skyrocketing prices and an exceedingly elevated demand. Google reported that the search question, "When is the housing market gonna crash?" had jumped 2,450% in the past month. Why is the market so hot? Searches had doubled in just a week, and in the most telling indication that the market bubble is running out of control, the question, "How much over asking price should I offer on a home 2021?" spiked 350% in that same week. I have to admit, I'm worried when I hear that. It does make me concerned, said Frank Nothaft, chief economist at CoreLogic. He continued to say, "That's the mindset that comes in because that means it's an auction market. We've got an acute shortage of supply on the market for sale at the same time that record low mortgage rates are driving the appetite to buy by millennials and Gen Xers," he explained. The mismatch between supply and demand drove 42% of home sales across the country to largely exceed their list price, according to real estate brokerage Redfin, marking a 16 percentage point increase from the same period last year. The housing market is more competitive than we've ever seen it, but a couple of indicators are causing us to ask whether we're nearing a peak in terms of how fast demand and prices can grow, highlighted Daryl Fairweather, Redfin's chief economist. Now, The Economist argues that the recent decline in mortgage purchase applications is a sign that large swathes of the population are being pushed out of the market because there's a lack of affordable homes for sale. If these trends continue, she said, it could mean that we are in the midst of runaway home price speculation and nearing a tipping point, considering that roughly 75% of the 100 largest U.S. real estate markets experienced an annual home price growth of 10% or higher. Markets with the most acute price depreciation could be most at risk of facing steep declines in the values of properties. That is to say, thriving markets like Boise City, Idaho, where prices went up by 26%. Spokane, Washington, where prices climbed 20%, might be the most susceptible to face a huge collapse in face of the coming housing market crash. In Boise, contractual absurdities such as waiving all contingencies are becoming common conditions as panic buyers attempt to enter the current rally before the boom is over. At this point, the median price of an existing home hit a record-breaking 17.2%, marking the highest annual price gain since 2006. The increase puts the national median home price at just under $350,000. And that's according to Stephen Culp with Reuters. That average is anticipated to grow further 9% until the end of 2021. On the flip side, the U.S. just had a 3.6-month supply of homes, the lowest point on record. By the numbers, it's becoming increasingly harder to deny that America's housing market is overheating. Green upholds that this is happening 80% because of the extraordinary amount of liquidity in the economy, 20% because of fundamentals. The investor also mentioned rising costs for lumber, suggesting a major inflationary spike will show up across several segments of the economy over the coming months. The Federal Reserve's monetary policies have not only expanded the home price bubble, but they've also created several other price bubbles due to rising inflation. Lumber prices portray that reality. In 12 months, prices spiked 340%, and new records are set almost on a daily basis. The surge in lumber costs added $35,872 to the price of an average new single-family home and $12,966 to the market value of an average new multi-family home, according to the NAHB. And considering lumber doesn't just go into framing a house. The price increase added costs to cabinets, doors, windows, and flooring. But of course, it's not just lumber. Prices of gypsum, which is used for drywall, spiked 7% from a year ago. Steel mill product prices are at record highs, jumping roughly 18% last month, and those materials are used for beams, sheet metal products, and wiring. Meanwhile, copper prices also set a new high this month, 27% up from a year ago. On top of that, there is land. The price per single lot shot up by 11% this year compared to last year, according to Zonda, a real estate data and advisory firm. And this is just the beginning. I think we're going to have inflation that no one is forecasting whatsoever, and it's going to have to lead to much higher interest rates, and that is going to slow down all these markets, Green warned. Most experts agree with the investors' forecast. Even though no one really knows when home prices may decrease, if rates continue to increase and home prices continue to rise, buyers will be unable to afford homes on the market, forcing sellers to lower their prices, stated Glenn Brunker, president of mortgage company Alley Homes. Prices can't keep going up forever, said Redfin's Ma. Strong increases in mortgage rates, which are likely coming soon, will inevitably cool home appreciation and bring prices back in line with wages. Even the Fed is signaling that the real estate market is frothy. In a recent event where Fed Chair Jerome Powell launched some sell programs, he revealed concerns about inflated assets without acknowledging the Fed's explicit role in creating and feeding the mentioned market froth. Rabobank Michael Every exclaimed that the most surprising thing was Powell daring to use the word frothy to describe the market he himself is boiling. 2 days later, Dallas Fed's Robert Kaplan admitted he's already observing imbalances in markets. I think it will be appropriate for us to start talking about adjusting those purchases, Kaplan said, highlighting that we've got real excesses in the housing market. Kaplan noted that rates should start to rise sooner than expected, but for the time being, the Fed will probably stick to its quantitative easing measures, continuing its long-term securities buying program of almost $80 billion in Treasury bonds and nearly $40 billion in agency mortgage-backed securities per month. That means the Federal Reserve is determined to keep mortgage rates low, adding more air to the housing bubble, outlined the economist, professor, and chair of the Department of Economics at LIU Post in New York, Panos Mourdoukoutas. The last time America's housing industry looked like this, the Great Recession occurred, property values plummeted, a massive wave of foreclosures was registered, and Americans lost trillions of dollars of equity and retirement savings. Even though this time around, the intrinsic supply and demand fundamentals might be different, in part due to the effects of the health crisis. But the panic buying and speculative exuberance look a lot like it did 15 years ago. As we've crossed the bubble zone and consumers aren't keeping up with the pace of the home price appreciation, when the housing market finally crashes, we will see our fragile post-outbreak economy falling again in a steep recession, and we'll be lucky if a global financial crisis doesn't follow.